Joining us right now is Krishna Guha, Evercore ISI's vice chairman, who heads the global policy and central bank strategy team. And Krishna, looking at this, I'd say that there's a lot of changes in opinion just over the last week and a half. What are you thinking right now?
I think June and 3 cuts this year is still the right base case. And I think that's what we heard from Powell yesterday at Stanford, right? The Fed is not getting freaked out by strength in growth and strength in payrolls. Why? Because they're buying into this story that the real key to understanding the U.S. economy is that we're going through a positive supply surprise. Labor supply is off the chart strong, mostly because of immigration, and productivity is looking good too. What this means is that the speed limit for non-inflationary growth, for non-inflationary payrolls, is just a lot higher than many people in the market think. Meanwhile, their assessment of inflation is that January was probably a bump in the road. So you've got to check the inflation data for March and April. But if that's broadly consistent with the idea that January was more noise than signal, they're going to go in June, and we can still confidently expect 3 cuts as the baseline, still even a chance of getting 4 by the end of the year.
Why do you think that even after Christopher Waller spoke at the Economic Club of New York last week and said multiple times throughout that speech that they're okay with being patient? That was before we got a stronger PCE number. It was before we got a stronger jobs outlook this week from ADP. It was before we got stronger ISM. Why would they necessarily rush to cut in June when they say they are data dependent and the data is leading them towards anything but that?
So I would certainly agree with you that because the economy is strong, because the labor market is strong, they don't have to cut rates if the inflation data disappoints again in March and April. And I think they're making that quite clear. They're not forced to cut. They cut if the inflation data confirms their baseline hypothesis, which is that the disinflation is still continuing. The key point that I'm trying to get across here, though, is that don't worry too much about strong growth. Because growth can be strong because demand is strong, but growth can be strong because supply is strong. And if supply and demand are strong together, no problem. That's just fine for the Fed.
Okay, I keep getting back to you keep saying the Fed thinks this, the Fed thinks that. Christopher Waller doesn't think that. Yesterday we had Raphael Bostic on, and he definitely doesn't think that. He thinks maybe 1 cut this year.
So
why are you so confident that the cuts are going to start in June?
So Raphael, for sure, is an outlier. We know that there are very few Fed officials who've taken that position in the dot plot. Raphael has his own logic for that, but I don't think that that is the sort of governing logic in terms of the Fed. In terms of my confidence that the right base case is that they're cutting in June, and let's be clear, it's not 90%, I'd put it at maybe 2/3 probability right now, is based on both my read of the data and my read of what they are saying. So Powell is saying, as you rightly quoted at the outset, that the strong growth, jobs, and inflation print for January, February has not materially changed the picture. That was the key takeaway from the Stanford speech. And it's, I think, very reasonable to read that as saying, as of now, June for 3 is still on track. Doesn't mean it's a slam dunk, but it's still on track. And then when we try to understand the economic analysis behind that, if you dig through that Powell-Stanford set of remarks, he just kept coming back to the strength on the supply side. Lots of workers available, helping to meet demand for workers, increasing the potential output, the non-inflationary speed limit for the U.S. economy. It's because of that supply side analysis, which has been a key theme of our work at Evercore ISI, that we're confident in the economics of disinflation. And when I listen to Powell, it sounds to me like he's buying into that thesis as well. Now, in the end, the data will tell who's right. But this is the working hypothesis.
Let me just read you one more comment. This is from Christopher Waller's speech to the Economic Club in New York last week. He said, the risk of waiting a little longer to cut rates is significantly lower than acting too soon. Cutting the policy rate too soon and risking a sustained rebound in inflation is something I want to avoid. we hear that from Roger Ferguson pretty consistently, the former vice chair of the Fed, who I think is very close to a lot of Fed members still, and who I know Jay Powell listens to. I just think if you're wrong, if there are not 3 rate cuts, if they don't start in June, does that change your outlook for where you think the markets are headed?
So I think for sure, if we started to worry about whether the Fed is going to be cutting rates at all this year, then that would be a big problem for the market. If it's a question of we're delaying from June to July, we're going from 3 to 2, market would have to adjust, but I don't think that that's the kind of thing that kills a bull market. But if I may, in terms of just Chris Waller, you're absolutely right. Chris expressed a risk preference. Powell didn't. Powell said two-sided risks yesterday, and that's important. He did not say one side more important than the other. The other thing I would say is Chris Waller, certainly more hawkish in his remarks. You're absolutely right. However, he also said that he would need to see at least 2 better inflation prints in order to cut rates. So he's actually not ruling out at all. March and April are more favorable. We can go in June.
Although the latest numbers that we saw, they revised upwards the previous month's reports for inflation, too.
Well, they revised up January, but February core PCE at 0.26 was at the very low end of market expectations between 0.25 and 0.30 based on the CPI and PPI data we'd already had. So January worse, but February better.
Krishna, here's my next question. Why is it such a terrible thing if the Fed doesn't cut rates, if they don't cut rates because the economy is doing better than anticipated?
Oh, I agree with you that, this is fundamentally a good news set of economic conditions, right? So if in the end the Fed decides, well, we're just going to wait until July or September, we're going to cut 2 times rather than 3 times, I think the market should get over that. The bull market, I think, can continue 100%. But the thing the Fed has to think about is a 5.5% Fed funds rate the sort of thing that can be sustained indefinitely without rolling the dice on the current very favorable set of economic conditions? Now, there's a lot of uncertainty as to where this famous neutral rate setting might eventually be found. But no one thinks neutral is 5.5. Literally, no one thinks neutral is 5.5. And so it's prudent for them to trim that rate back down towards, say, 4.5, which is where you get about, say 3 cuts, 3 to 4 cuts. It's prudent for them to do that as soon as, but not before, they can confirm that the basic disinflation trajectory is still on track. And that's about the nominal data, prices and wages. It's not really about growth and payrolls.